Every stock market crash in history started the same way, when investors felt safest. Not scared, not worried, confident. And right now, those exact conditions are quietly lining up again. Right now, while most people are feeling comfortable, confident, and even excited about the stock market, history is quietly flashing warning signs. The scary part is this: every major stock market crash did not start with panic. It started with confidence. It started when people believed, this time is different. And if you stay with me for the next few minutes, you'll clearly understand the exact conditions that have triggered every major stock market crash in history, and why many of those same conditions are lining up again right now. Before we go deeper, if you want smart, calm, long-term investing insights that actually help you protect and grow your money, make sure you like this video and subscribe to the WISE Investors. It helps the channel grow and ensures you don't miss what most investors realize too late. Now, let's rewind history for a moment. Go back to 1929. Before the Great Depression, the stock market was soaring. People were borrowing money to invest. Stocks were hitting new highs almost every week. Newspapers said the economy was unstoppable. Sound familiar? Then look at 2000, the dot-com bubble. Companies with no profits, sometimes no real business, were valued at billions. Investors believed technology had changed the rules forever. Then 2008. Home prices were rising, credit was cheap, risk was ignored, and Wall Street assured everyone the system was safe. Each time, the story was the same. Different era, different excuse, same ending. Here is the first condition that always appears before a crash: extreme optimism. When most investors believe the market can only go up, risk disappears from their thinking. You hear phrases like "by the dip, stocks always recover," and "you can't lose long-term." Optimism itself is not bad, but blind optimism is dangerous. Right before crashes, bad news gets ignored and good news gets exaggerated. This is when smart money slowly starts leaving, quietly, while the crowd is still cheering. The second condition is excessive leverage. This means too much borrowed money in the system. Margin debt before 1929 was at record highs. Margin debt before 2000 was massive. Housing leverage before 2008 was insane. Whenever people borrow heavily to invest, even a small drop can force selling. Forced selling creates panic. Panic feeds on itself. Today, leverage exists in new forms: margin accounts, options trading, crypto-linked leverage, and corporate debt. Different tools, same risk. The third condition is a disconnect between prices and reality. When stock prices grow much faster than company profits, something breaks eventually. In 2000, many tech stocks had no earnings at all. In 2008, home prices had completely detached from household incomes. When valuation stops making sense, the market becomes fragile. It doesn't need bad news. It just needs a trigger. Another pattern that always shows up is central bank pressure. Before almost every crash, interest rates were rising or liquidity was being removed. In 1929, the Federal Reserve tightened credit. In 2000, rates had been rising for years. In 2008, rate hikes and credit tightening exposed weak loans. When money becomes more expensive, weak businesses fail first, then weaker investors panic, and then the dominoes fall. Now here's the part most people miss. Crashes are not caused by one event. They are caused by systems already under stress. The event is just the spark. It could be a bank failure, a war, inflation data, or a policy mistake. But the real cause is always the same: too much confidence, too much debt, too much speculation, and too little margin for error. This is why the market often crashes when things seem fine. By the time everyone sees danger clearly, the crash has already happened. The smartest investors don't try to predict the exact day. They prepare when conditions start to repeat. At the WISE Investors, we don't believe in fear-based investing. We believe in awareness. Knowing these patterns doesn't mean you sell everything tomorrow. It means you manage risk smarter. It means you stop chasing hype. It means you keep cash, diversify, and think long-term instead of emotionally. Another historical signal is retail investor dominance. Before crashes, everyday investors rush in aggressively, often through new platforms or trendy assets. In 1929, it was bucket shops. In 2000, it was online trading accounts. In 2021, it was zero commission apps and meme stocks. When investing becomes entertainment instead of strategy, risk increases fast. Also pay attention to narratives. Right before crashes, there is always a powerful story. Technology has changed everything. Housing never goes down. This time is different. Markets don't crash because people are scared. They crash because people are convinced nothing can go wrong. Now, let me say something important. Markets will recover long-term. History proves that too. But crashes destroy unprepared investors. They force selling at the worst time. They cause emotional damage that keeps people out of the market for years. Preparation is not about timing. It's about survival. If you've made it this far, you're already ahead of most investors. You're thinking instead of reacting. And that alone puts you in a stronger position. As we move forward, remember this. Crashes don't announce themselves. They whisper. They repeat patterns. And history never copies itself perfectly, but it always rhymes. Before you go, I want you to comment below. Do you think we are closer to a major market correction? Or do you believe this cycle is different? Your comment helps others see different perspectives, and I personally read them. Also, share this video with someone who thinks the market can never fall again. You might help them avoid a costly mistake. Make sure you're subscribed to the WISE Investors for calm, intelligent investing content that focuses on clarity, not hype. Stay patient, stay informed, and most importantly, stay wise.